Thanks so much for joining in on Talking Point today. I'm your host, Neeraj Shah. Our guest today is Manpreet Gill of Standard Chartered. Manpreet, great having you. Thanks for taking the time out.
Neeraj, thanks for having me on.
You are kind of in the hotbed of activity currently, Manpreet. And there's one question that is going out to all risk asset watchers is whether the geopolitical news flow, be it what's happening between Israel and Gaza, or, well, we've heard this morning that Vladimir Putin is in China and that axis with all the Russia versus the West, how big an event it is to upend the positive momentum that had come back into risk assets, particularly equities, in the last 4-5 months?
Well, indeed, I think we're living in a particularly geopolitically charged world. But I think what's important here, and indeed with every geopolitical event, is to remember that financial markets ultimately have a narrow view. So many of the events you described, of course, very significant from a political standpoint. But the question we always ask ourselves is, what's the channel back to financial markets? And how significant is it that that channel gets activated? So if I take the history of Middle East conflicts, for example, the vast majority of them over the past 5 to 6 decades had largely no impact on financial markets, including on oil prices. And the reason for that is, if you think about conflicts that involved Israel and its neighbors, for example, they didn't really involve a significant interruption of oil supplies. Now, there were some conflicts that did, like the Gulf Wars, and we did see a reaction in markets. But for us, that's really the key. And I think if I think about some of the events you've described, at the moment at least, we don't see a significant lasting impact to markets to the oil price channel. But of course, there are several scenarios we're sort of putting around this. And I think that's, whether we escalate within those scenarios is, I think, one of the key thing to watch.
Okay. Ceteris paribus, assuming that this doesn't escalate too much, am I to take it that you are constructive equities currently?
So we sort of, in the short term, we could argue yes. So I think overall we have sort of a core holding view on global equity markets. And I think more constructive in some regions and sectors than others. I think we're sort of going through some seasonality. September was poor. We think seasonality will improve as we go into year end. If we start to get positive earnings growth in the US earnings season, for example, I think that will start to put a little bit of floor in the short term. But our preference, of course, is to pick one's regional bet. So as opposed to US equities, which remain the dominant market globally, we'd rather own Japanese equities, for example. Similar cyclical exposure, but a much cheaper starting point. But I think that's more sort of a view over the next couple of months. I think the big looming question for us still is, how much does economic growth in the US and globally slow after all the interest rate hikes? And indeed, the fact that bond yields are now a little bit higher than the earnings yield on the S&P 500, that I think is something which is why longer term, we still prefer high-quality bonds relative to equities.
Wow. Okay. So how short is this short term? How long is this long term? My question really is, from an Indian market watcher's perspective, and let's assume that the average investor maybe has marginal investments in the US, can't buy into Japanese equities per se, and is trying to figure out whether it's worthwhile to hold on to Indian equities currently, or can one make a tactical call simply because there might be a bit of a risk off, there might be a beeline towards bonds because of safe haven, so on and so forth. Is there any view there?
Yes, and I should have been more specific on the time horizon. I think when we're talking about shorter term, we're really looking at the next couple of months from now till about year end. I think that some of the bigger questions start coming through on growth in 2024 by mid-year, 12 months or so out. I think Indian equities, though, or Indian markets rather, are in a more interesting point, because our view is that it's a good time to have a balanced exposure between equities and bonds. So core holding on both sides, taking more sort of sector picks, corporate bond picks alongside, government bonds. So it's about diversification. The reason is that, look, Indian equities can't be immune if we get volatility in global markets, but we think they are in a better position, clearly. The growth outlook is incrementally better than what we're seeing elsewhere in the emerging world, arguably even a large part of the developed world. But we can't ignore the fact that bond yields on G-Secs are actually quite interesting as well. And if anything, there are inflation pressures, but perhaps not as significant as what we're seeing in the US. So incrementally, I think a better place to be compared to what I described on US markets. But I think it's a great time to be diversified. We would expect some volatility, but that volatility is what we use not only on the equity side, but also on the bond side.
A clutch of investors and fairly accomplished blue-blooded names I'm talking about, have this opinion that there could be a possibility that India is viewed as an oasis of calm, as a pocket of certainty in an uncertain world, and therefore all the troubles around us might actually work to India's advantage, both in terms of flows, also keeping in mind that the domestic flows are so strong that now foreigners know that they cannot wait for an overextended correction in Indian markets to take advantage of, as used to happen maybe a decade ago. Any thoughts?
Well, I think from a macro perspective, absolutely. I mean, when you think about, as I described, economic growth, the outlook and current conditions in India do look a lot better than what you can find in the region and indeed in a large part of the world. Inflation, yes, something to pay attention to, but perhaps not as much alarm as elsewhere. And the many other indicators you can point to. In the quality of bank balance sheets, for example, there were challenges some years ago. Today, perhaps not as much, which is another stark contrast to the rest of the world. I think what we're trying to balance that is versus where's the valuation starting point for equities and how much correlation or how much can the correlation or the breakdown between global asset classes and domestic ones. So I think, look, there's a strong case, I'd agree, for markets potentially to be less volatile. We have some volatility elsewhere. I think Indian equities have benefited a lot, for example, in weakness elsewhere in Asia. I think that sort of helped a lot from an international investor perspective. Domestic flows, as you described, continue to be very strong. But we wouldn't go out there with the starting assumption that the correlation between Indian equities and Indian bonds would completely break down should we see sell-off in US equities. That correlation might be a lot lower than it has been in the past. That's reasonable. So I think it's more about surviving the journey, and that's why, look, unlike the US, it's not that we're saying we overweight bonds relative to equities in India. In fact, that's part of the reason why we think a balanced exposure makes sense. We're less worried about equity markets in India relative to the US. That suggests volatility. Any volatility, great example to add exposure or continue some sort of systematic investments. But we don't want to miss the opportunity that today's bond yields are providing either, because for income-oriented investors in particular, whether in India or elsewhere, we seem to be close to cyclical high in bond yields, and that's not a bad time to lock in some yields for the next few years.
Got it. By the way, sorry, so just wondering, just to probe that point in little detail, how significant do you reckon this JP Morgan bond inclusion would be overall in the larger scheme of things? More so also that if one has happened, then maybe some of the other global indices also follow suit, and can that happen, and will that be material?
So I think it's interesting when you're thinking multi-year. I think, we've looked at examples of index inclusion of other markets, in the past. And I think you tend to see they're harder to trade around because you tend to see the impact of those built in before the inclusion. But I think where they start to become interesting over a few years is that you start to get more sustained flows. You start to see lower volatility. You start to see more of a cap and a long-term sort of downtrend in the level of bond yields. And these are incremental relative to where they would have gone otherwise. But I think in all those sort of conditions, do improve the outlook. So when you're thinking of building portfolios with combined equities and bonds, this I think is a big positive. It does mean that the risks of foreign investor flows having a greater or disproportionate impact when there are global worries about strong dollar, risk off, those become a bit more of an issue. But I think the benefits outweigh the costs.
Great. Final question, Manpreet, on Indian equities per se. So there are various pockets, and I know you may not have a complete handle on the minutiae because you look at Asia largely, but still, by virtue of your earlier interest or current interest as well, I'm just trying to understand what pockets look interesting. I'm getting various views. So banks, for example, haven't done anything in the last 6 to 9 to 12 months in terms of stock market performance per se, but the fundamental numbers seem to be decent. At the same time, IT is facing the challenge of lower guidance in the near term, but maybe a turn of events, if not from 2024, then maybe 2025, and that might start getting discounted after the first half of 2024 as well, calendar year 24. Just trying to understand, how are you thinking about some of the large pockets within the Indian equity landscape?
So I think for us, we're very fundamental driven investors. And I think what you described on banks is something we really do subscribe to, because I think, look, obviously you described how some of the numbers are starting to look interesting. Everything we discussed on the bond yield side is actually also a great environment, for banks as well. And the growth angle, of course, is still very much there. So I think that's really what I subscribe to. I understand the frustration of not having gone anywhere. I think that's partly because in India and elsewhere, we've been more of a trading environment as opposed to one driven, directly by long-term fundamentals. But in our view, fundamentals ultimately dominate. And I think a combination of, strong sort of results and, higher bond yields, steep yield curve, those are all positives. I think that's one pocket we subscribe to. I think we talk about more cyclical sectors like technology. Look, to be honest, it's something we find interesting. We just rather wait for an opportunity to pay a better price. If valuations do come up even to some degree, I think that's something we'd be sort of keeping on the radar. But for us, more of a core holding at the moment, perhaps not the pocket we'd be allocating the largest amount to from a sector perspective. So I think a couple of sort of themes over there, but really sort of looking at where the fundamental signals are and just staying the course. And banks, of course, great example of that.
Got it. Manpreet, great having you. Thanks for taking the time out and speaking to us today, and look forward to talk to you more often.
Thanks very much for having me on.
And the pleasure was ours, and viewers, thanks for tuning in.